Very good morning to all. It is a pleasure to be with you, from my Economy and Finance channel. I hope you are feeling very well and are ready to acquire new knowledge in this very important field. Today we will continue with our trading course and talk about what is technical analysis. Let's start. Technical analysis is a way of analyzing financial markets to try to predict the value of prices, using past prices, and various analyses that have to do with indicators, chart analysis, trends and price volumes. For what has been said, chartism is an integral part of technical analysis, the latter being a more comprehensive concept. Prices make up various figures, with certain names, that make up patterns, and through these figures one can access the probability that a price has of following a trend, or reversing it. The term graphic pattern refers to the formation of a figure with a certain regularity. This repetition provides information about a behavior, in this case the prices of a financial asset. It is important to highlight that chart analysis is based on three premises. The price discounts everything. It means that the price reflects the attitude of investors when buying or selling a specific asset, regardless of the causes, since prices indicate the consequence of that investing action. Prices move in trends. It means that prices are setting a trend, which the investor tries to find out to see if that trend is running out to reverse, or can continue. History always repeats itself. This means that history repeats itself, and this is reflected in prices. Before talking about price figures, it is important to address the type of main charts used to analyze them. Line graphs. A line chart is the representation of prices over time, considering closing prices. By joining the different prices, the line that gives shape to this type of graph is formed. In a bar chart, each vertical bar represents a period of time, and also reports the price path over that time, taking into account the following. Opening price, indicated with a horizontal line, to the left, starting from the vertical bar. Closing price, indicated with a horizontal line, to the right, starting from the vertical bar. Maximum price, is given by the upper end of the vertical bar. Minimum price, it is given by the lower end of the vertical bar. If we use conventional colors such as green and red, when the bars are green it means that the price has risen in the analyzed time period, and if they are red, it is because the price has decreased on that day. Candlestick charts began to be used in Japan in the 17th century, in order to predict the price of rice. In this type of chart we have the prices represented by candles. Here we have the bodies of the candles in the upper and lower shadows. The lower base of the body of the candle, in a bullish candle, is the opening price and the upper base is the closing price, with the lower and upper shadows of said candle being the minimums and maximums reached on that day. The upper base of the body of the candle, in a bearish candle, is the opening price and the lower base is the closing price, with the lower and upper shadows of said candle being the minimums and maximums reached on that day. If you liked this video, be sure to subscribe to our channel and activate the notification bell, giving it a like, and sharing with friends and family, so they can benefit from our economic information and our financial tips. Have a great day, and see you in the next video.